Hey everyone, in today's video, we're going to be doing a portfolio review and update of my $203,000 Wealthsimple portfolio. We're going to be going through all of the stocks I hold. I'll give some of my thoughts on them. But before jumping into this, if you wouldn't mind taking a second to like the video, it really does help me with the YouTube algorithm. Also consider subscribing to the channel. We're a very small channel, so all the help really is appreciated. Okay, going into my portfolio here. So I have about 3/4 of my portfolio in Canadian stocks, 1/4 in American stocks, just looking about the growth of the portfolio over time. So I started this portfolio near the end of 2020 with my first few deposits. You can see it up there, a couple $1,000s here, October 2020. And I slowly just was able to deposit more and more money in my portfolio as time went on. So by about my first year in, I had about $45,000 in value in the portfolio. If I go to the end of 2021, beginning of 2022, I was up close to 60,000. And then I've really been focusing on investing into this portfolio more recently. You can see here, this drop here is when it broke off into a USD and CAD account. So the amount went down in the CAD account here, but I was able to get this portfolio up to about $90,000 at the 2-year mark in the Canadian account. Jumped over $100,000 as we entered 2023. It's currently at about $140,000. On the US side, this is more only about an 18-month portfolio, because that's when Wealthsimple let us do USD accounts. And you can see here that lots of the growth in this account, up about 7,200 US dollars, has only been this year. I was flat in this account earlier this year even. So all the growth's really been this year, and we'll talk about what drove that as we get into the US side of my portfolio. But jumping into the stocks that I own, for those of you who've seen some of my other videos, not too much has changed. I've added a couple positions, but I'll kind of give my recent thoughts on some of these stocks. Allied Properties, this is one that I haven't been adding too much to. I think I added maybe 10 or 15 shares over the last couple months. But this is a stock that is primarily an office REIT in Canada, but they do own really high quality office space in downtown cores. Their funds from operations have been flat since before COVID, about $2.20 a share, give or take. So they're trading at under 10 times earnings now. For perspective, this stock used to trade at almost 25 times earnings because of the quality of the locations of their offices. So this is a huge margin contraction, but they haven't really seen it impacting their earnings per share or funds from operations yet in terms of the sentiment around offices. Some of that may be coming still, but this valuation has just gotten slaughtered. You can see here the stock was trading for about $60 right before COVID hit. And we go down because of the deceleration of the multiple. They're yielding 8.2%. So very high yielding company. I'd say if there's not an absolute destruction of office space, this company will be fine, and they even have about 10% of their funds from operations coming from retail and some other types of assets. So I definitely think this is one of the riskier plays in my portfolio, but I don't want it to be a big position, only about $4,000 here, but I just think the value that it's trading at is more than the haircut that it deserves for being an office REIT in core Canadian cities. So that's my thoughts on that one. Not gonna load the boat on it, but don't mind nibbling on it at over an 8% yield for an asset that hasn't really deteriorated their earnings. I think that one is undervalued in my opinion. Many most disagree. Lots of people say, oh, it's an office REIT, but like at the end of the day, it's still producing income and it still has value. So you can have that opinion, but it's like, what's it worth to you, and why is it worth that valuation? At under 10 times with a free cash flow yield over 10%, you cannot buy office buildings of this caliber in major cities in Canada for those kinds of free cash flow yield. So I do think it's undervalued, and everything that's producing cash today and into the future has some level of value. So I just think that one's undervalued for where it is. A&W Royalty is one that I've been aggressively building. I wanted to build it to 525 shares because At that level, the stock is paying me over $1,000 a year in dividends. I'm getting paid like 83, 84 bucks a month, something like that. So that's great. And the other thing is, this one's actually like flatlined to have been slightly down over the last year, despite decent results. So I kind of liked that. I felt like I was buying it at a small discount. You see here it was trading in the high 30s a lot, touched $40. And I kind of have an average price on it closer to 36, I believe. Yeah, 36, 33. So thought I was getting in at a fair price, built it up into a $18,000 position. And what I like about A&W Royalty is that it's a very defensive company. It's a quick service restaurant across Canada. They're in malls, which may be a bit more at risk, but also at like highway stops. They have tons of downtown locations. They have tons of standalone locations in smaller towns. They're well diversified across Canada. They have a big presence out east. So I just thought this was a good diversifier for my portfolio, and getting $1,000 of income from it a year was a good number. Bank of Nova Scotia. This is actually another one that I've been adding to on weakness. The bank stocks in Canada have done really well over time. It's trading at a 6.4% yield, and this is a stock that has mostly increased their dividend on an annual basis over the last 50 years. So I can see this stock 10 years from now, especially if the economy turns around, providing me a yield on cost of over 10% of what I'm buying it for right now, which in 5 to 10 years, having that kind of yield on cost is fantastic. So I'm bullish on Canadian banks overall. They're an oligopoly. They continue to spin out tons of cash flow, tons of profits. They buy back shares. They pay huge dividends. They're historically undervalued at these areas, and they've always done well over the long term. So this is one that I'm nibbling on as well, buying 5 shares here, 10 shares there. And this and TD Bank are the two banks that I have been buying recently. All right, we're going to skip a couple of them here because I have lots of REITs like Cap REIT here, and First Capital REIT here. In addition to that, some utility companies like Fortis, Canadian Utilities. My thoughts on REITs generally are that they're all a bit undervalued. Some are more undervalued than others. I don't think Cap REIT's too undervalued here at about $50. Some of the retail REITs I think are a bit undervalued. RioCan, First Capital. So I'm not minding adding a tiny bit of shares here and there, but I want to be careful with how much retail exposure I have overall, given their exposure to things like interest rates. So kind of picking my spots, going with the most undervalued ones, nibbling on Allied, nibbling on Realty Income, which is another stock I recently added, but trying not to go too heavy into REITs overall. CN Rail is one that is probably my favorite stock in my portfolio, but I haven't really been buying much of it recently, just because of how well they've been holding up. If I look at the stock chart over the last year, or even longer, if I give you a view since like COVID, this stock is still not too far off of its all-time highs. So sometimes I buy a share here and there, but recently I haven't been buying just because the valuation is probably fairly priced here, and I just feel like there's better opportunities across my portfolio. Canadian Utilities is one that I haven't really been buying into recently. Diversified Royalty Corp. They have a lot of stuff going on in this company here. First of all, Air Miles just got acquired by BMO, so I want to see how that partnership goes, as Div still owns the trademark rights for that business. Some of the auto parts makers in the U.S. Recently reported poor numbers. About half of their royalty income comes from Mr. Lube in Canada. So that's one that is probably the main reason this one's dipped from $3 to $2.80 over the past few weeks. And then they just have a couple other businesses like Sudden Realty Group, that's really reliant on real estate sales and real estate agents, which has been slowing down in Canada in terms of sales volume. So just lots of moving parts on this company. So I'm going to wait and see what they report next quarter, and then we'll go from there on that one. Continuing to go down here, my covered call ETFs, I have a bunch of them: HDIF, Huddle, Life are three of them here. I haven't been buying these at all. I kind of built them into relatively sizable positions. 7,000 bucks on Life, 4,000 bucks here, 4,000 bucks there. Have a couple more later down the chart, and I've just been using them for cash flow. So I get hundreds of dollars a month in dividend income from these covered call ETFs that I can uh, use as capital towards dividend growth stocks or high yielding stocks like Allied. So I've just been using this as a source of cash. I don't want to be too exposed to these, so I've been holding off on investing more in any of them. They have high management fees. They tend not to have capital appreciation over time, so they're really just a source of monthly income for me to fuel other areas of my portfolio. Keg Royalty is one that it has not been my royalty of choice to add to, just because I felt like A&W has consistently been a better option. If I look over the last year, you can see here that they haven't really dipped too much from their highs. They were up at 16.50 for a bit, went over 16 again, but currently at 15.50. Whereas we saw A&W go down from 40 bucks down to $33, a much bigger dip, and much better valuation relative to what you're getting. I feel like the keg isn't as defensive of a stock to own and an income stream to own. So that's why I was more focused on A&W Royalty Corp over the last handful of months. I haven't added to the keg in a while. Northwest Healthcare. This has been my worst performing stock in my portfolio, maybe that I've ever bought in across all my portfolios. So lots going on here, down 20% in the last month as a deal, a joint venture deal with one of their business units in the UK fell apart. I think the other partner walked away, so that raised a lot of questions. But just down 50% in the last year. It's paying a huge dividend. I don't know if this is going to get cut. I'd imagine it is at some point. 13% just isn't sustainable, and they obviously have other issues going on with the company. When I first bought this company, it was straightforward. They own medical centers, stuff like that. Over the years, they entered into management contracts and all these other things that put a lot more complexity on the business and made it very hard to analyze, to be honest. So it's one that I've shied away from looking into too deep, other than top line earnings over the last few years. And shame on me, because whatever is going on in terms of the volatility with this company, the interest rate exposure has really destroyed this stock. So I have it on my watch list to do a deeper dive in the Northwest just to understand what's going on. But this one has definitely been a pain point for me across my portfolios. Still getting that dividend every month, so just similar to Keg Royalty and my covered calls, taking it, investing it in other spots. But it does kill me to see this stock continue to go down week after week after week, now down probably about 50% versus my average buy price on it across my portfolios. Quick service restaurant. This has been one of the highest return stocks in my Wealthsimple portfolio, up 34% there. This stock has really done well over the last year, up about 60%. They own the Burger King brand, Popeyes brand, Firehouse Sub brand, and Tim Hortons brand, and they primarily license these brands to franchisees. So great capital or asset-light business model. They're in charge of the brands, driving traffic to the stores, driving profitability for franchisees. And they've done a really good job of starting to turn around the ship on some of their businesses. Tim Hortons has been doing really well lately, bouncing back from COVID. Burger King's finally starting to get some traction in the US, which is a big deal. And they're seeing some good momentum internationally as well across their business. So lots of positives here. Hopefully they can continue to grow on it. And they trade at a lower multiple versus some of the other big fast food stocks. So that's why I first got into that one. Rogers Communication finally acquired Shaw. So haven't been buying any Rogers over the last probably 6 months, 8 months. As first I wanted to see how the Shaw deal closed or not, because I thought there may be some response if it didn't from the stock. And now that they've closed on it, I want to see a couple quarters of earnings and plans to integrate Shaw and the impact on earnings per share and dividend growth outlook and stuff like that. So I'm just paused on this one in this account. Ryokan, this is one of my biggest positions, not in this account, but across all my um, collective portfolios. This one's been hit 6% in the last month. Um, but once again, I really want to manage my REIT exposure. So I haven't really been buying too much of this one because I've been buying realty income in the US. 5.5% dividend yield here. They're going to do about a buck 80 in funds from operation this year. So they're trading at about a 10 and a half funds from operation multiple for the assets they own. I think that's a very good valuation historically speaking. So another one that I think I get why people don't want to be too heavy in retail, but I just think the underlying valuation is too low for a business like Ryokan. TD Bank has been one. I haven't been buying it too much lately because I've been more buying Scotiabank the last month or so, but is one that I have my eye on to add shares here and there. Another big position across my portfolio. ZDI, this is one that I actually started buying more of again recently as it flatlined a bit. It's up huge as some of the economic impact in Europe, or the sentiment of it at least, has somewhat diminished. But BMO International Dividend ETF essentially owns blue chip dividend stocks from across Europe, Japan, Australia, but they're really big in like France, UK, Germany, those kinds of countries there. So I get some great geographical diversification here, and I also get like about a 4.5% dividend yield. So it's a juicy dividend yield. Gets paid monthly. They hold blue chip stocks. I get global exposure. So this is one that I love having this ETF. It makes me sleep better at night knowing I'm a bit diversified out of North America. And it's one that I'd buy more of. I just am managing my cost basis there and trying to buy at good prices. And wrapping up my Canadian portfolio, two more covered call ETFs. ZWB is covered called on Canadian banks. ZWC is covered calls across high dividend paying stocks in Canada. Similar sentiment on these as my other covered calls. I just really use them for income at this point. Get that income, invest them in strategic alternatives that I have at that point across my portfolio. So that's the Canadian side of my portfolio. Going into the US side here. The US side, as I said, has really been the growth driver for my portfolio over the last 6 months or so. So I'm up 7,200, so about 10,000 Canadian dollars just in year to date in this portfolio. So let's look at some of the drivers here. Google up 17% at about 120 bucks there. I haven't been buying too much Google recently. I've been more focused on my dividend stocks. So this one's just been a bit of a hold, but nice to see that I'm up. Coca-Cola, I'm more or less flat, let's call it. McDonald's has been a big driver as they've reached like all-time highs. Meta's been huge overall. The stock is up almost 200%, even though it's just what was just like a $1,000 position. It's almost tripled, or it's now got from like about $1,000 or just over $1,000 to over $3,000. So this has been, for a small investment, a huge driver of the portfolio on the US side. Microsoft, pretty big position there, up $2,500. Realty income, this is a new position for me. I've been aggressively trying to build it up. So I'm at 100 shares right now, I believe, or maybe 110. Yeah, 110 shares. Just get a nice, reliable monthly dividend here. And this has been one of the reasons I've been cautious on adding to my retail REITs in Canada, because I'm already allocating capital towards realty income in the US. So I want to be careful with how much I'm allocating to retail REITs and REITs in general at the same time, just to manage the exposure in my portfolio. PG, this is just one that I've had in this portfolio for a while. Get a nice, reliable quarterly dividend, get an annual dividend increase, and that's just a relatively small position here, but I've done okay on it. AT&T, this one has been challenging for me. Aside from Northwest Healthcare, probably one of the stocks that across my portfolio as well, a pretty small position overall, has given me the most trouble or the most heartache in terms of valuation. So this one's down 25% in the last year. It's been down year after year after year for about 3 years now that I've been holding it. And it's now at a 7% dividend yield. I've just always found the stock to be too cheap on a free cash flow and an earnings multiple basis. So I believe they're going to do about $2.50 in earnings per share this year. So that gives this stock about a 6 times earnings multiple. On 6 times, that means they're yielding about 16-17% returns on equity. And at that, they're paying their 7% dividend. And then they have like 10% of their market cap essentially to invest in new innovation, growing their business, acquisitions, or just what they should be doing is paying down debt. But you think if they can continually have that kind of free cash flow and available cash with a stock this cheap, you think they can just over time reduce their debt loads and the valuation and the multiple will increase. Now, that consensus and hypothesis hasn't played out over the last couple of years, so I keep a close eye on this one, but I am down about 22% in this portfolio, so it hasn't been a good bet for me so far, but I'm holding on to it. Okay, one of my favorite stocks I hold, and it was one of my priorities this year to buy more into, and I'm doing that, is Visa. I think they just have fantastic business model, global company. In addition to growing with the overall economy, they have additional tailwinds as people go from cash to card. They trade at a relatively reasonable valuation, around 28-ish times earnings, and they've been growing their earnings per share on a compounded double-digit rate for like a decade straight. So I think that's going to continue. So that 28 times earnings will be a 25 times earnings next year, which will be a 22 times earnings a year after. And I think they'll continue to grow double digits into the medium term. So this is when I have 38 shares in this account. I think I just reached 75 shares overall across all of my accounts. So would love to continue to build this at valuations at like 220 or lower. I continue to buy into the stock, getting it closer to 100 shares across my portfolios. And then I have two of my newest stocks. So both of these stocks you see here, I only have 20 shares of, so both very small, hoping both of them go down so I can build up bigger positions in them. If they go up a lot and I don't think the valuation's attractive anymore, I consider dumping them and waiting for another time to get in, or allocating them and the gains to another area of the portfolio. But Vici, I like this stock because has a nice starting yield, 5% starting yield, and they trade for about 15 times funds from operation, but they do have inflation adjustments in their rent. They collect 100% of their rent, even through COVID, which was a great stress test for them in the grand scheme of things. And they're looking to drive a lot of scale in their business, grow with their existing partners. So I can see them growing their funds from operations high single digits over the years. So that 15 times I'm paying today, I think will probably be 13 and a half to 14 times next year, and maybe 12 times the year after. And I'll get some dividend growth on that on top of the 5% starting yield that I have. So I think this is an interesting play. I don't want to make it a huge position, but it's one that I wouldn't mind building into, like a couple hundred shares, 250 shares maybe, depending on the valuation. And I'm very early on that journey here with just 20. Going on to my last stock I have here, Wyndham Hotels and Resorts. I've always loved their business model, always loved the stock. It's trading probably at the high end of what I'm comfortable with. They're into about $3.50 shares of earnings per share this year. $3.50, sorry. So this is trading about 19 times earnings for a hotel chain, a franchisee model hotel chain that is pretty susceptible to the macro economy, given the type of consumers that they tend to serve. Big exposure in like middle America, stuff like that. They're trying to grow internationally, and they are, but it's going to take a while for them to diversify farther away from the US. Stock's been flat for about a year. So on this one here, I'd love to get it closer to a 15, 16 times. I'd love the stock to go under $60. That's where I think I'd actually get maybe a good buy-in price. I think the valuation here is definitely fair, at a like fair to potentially maybe a couple bucks too high in my opinion. But long term, I think they have a great capital allocation model to growing shareholder value. They buy back a lot of shares, they pay a dividend. On top of that, they do some tuck-in acquisitions. They just bought Vienna House, which has like 50 hotels across Austria and Germany, I think. And they do stuff like that to increase their royalty income and licensing income. They also have very asset light model, which I really like. It's essentially like a royalty company, which, as you saw across my Canadian portfolio, I really like to own. So love that stock or love that company. Don't love the valuation, which is why I'm like tiptoeing my way into it. But would love for it to go down more so I can actually make that into a permanent holding in my portfolio. So there you have it. There is my Canadian and US portfolio. Finally cracked over $200,000 as I've been trying to focus more and more on investing more in this account. And those are the stocks I hold. Gave you some perspective on what I'm focusing on adding more to and what I'm just holding on collecting dividends. Would love to hear your thoughts on any of these stocks in the comments of the video. And if you made it all the way through, be sure to let me know in the comments as well. Not too many people watch to the very end, so I really do appreciate it. Thank you guys for watching. Subscribe to the channel, and I'll see you guys in the next one.